Welcome everyone to our webinar this afternoon. We're going to be getting going in just a minute here, and just a couple of housekeeping items as we are waiting for a few more people to log in. If you guys can hear my voice clearly and if you can see our screens, please give us a thumbs up to let us know. Awesome. It's great to see a lot of familiar faces. Many of our clients are joining. It's a very important topic for all of us, I believe, because most of us are investors. And we do have the perfect expert joining us today. But before we dive into the topic, I'm just going to briefly explain about Sense Financial, what we do, for those of you who are new. Just a quick information about myself. I'm the founder and president of Sense Financial Services. We are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. And we've been serving our clients since 2010. Our clients are loving us because that's evidenced by hundreds of reviews that we have on various platforms. And since 2010, we assisted well over 3,000 clients establish over 4,000 self-directed retirement plans. Just very quickly about the benefits of a self-directed IRA and a solo 401k. These retirement plans allow you to invest in alternative assets, because with your conventional IRA and 401k, you're limited to the stock market only. You can invest in a tax-deferred manner or tax-free by utilizing a Roth. You can leverage your funds by using a non-recourse loan to invest in real estate. All of our plans, they do come with the checkbook control, so you can either eliminate or bypass the custodian, so there is no middleman that you have to go through. And solo 401k specifically is a great tax shelter, because you can contribute over $70,000 or potentially doubling that. If you're married with your spouse, you can double those contributions. So it is a great tax shelter. You can do a lot of things, virtually unlimited investment options. You just got to be aware of a couple of limitations. IRS Internal Revenue Code 4975 states that you're not allowed to invest in collectibles and life insurance with your IRA, and you are also prohibited from engaging your IRA or 401k in any transaction with a disqualified person, which is immediate family members. Unlimited investment options means real estate, commercial and residential, tax liens, promissory notes, precious metals, cryptocurrency. You can use your IRA or 401k as a bank, and you can lend money to others. This is very popular investment option. My personal favorite, by the way, too. And true diversification means that you are not just keeping money in one basket, right? You're able to diversify in different baskets. And this cartoon created to my daughter illustrates it very well. If you everything and just one basket and something happens, then all of the eggs are gone. Ecclesiastes 11:2 says, divide your portion to 7 or even 8, for you do not know what misfortune may occur in the earth. And I think all of us basically experienced that, going back a few years ago with the COVID, what happens with the stock market then. Go back a decade prior to that, you've seen what happens with the stock market. And but once you diversify, you can actually achieve lower risk, you can achieve greater returns, and you can invest passively. So that's just a very brief introduction about what we do here at Sense Financial. But again, the topic today will be on top tax strategies for real estate investors. And Tony is going to be our presenter. He's going to share his screen here. And Tony is a tax expert with Robert Hall & Associates. He personally manages clients with over $500 million in real estate holdings. He has spoken for hundreds of trade organizations throughout the state of California, and he holds a federal license as an enrolled agent tax practitioner. He can advise, represent, and prepare tax returns for individuals, partnerships, corporations, or any other entity for tax reporting requirements. Aside from his full-time position at Robert Hall & Associates, Tony is also active real estate investor. So he's practicing what he's preaching. He's an entrepreneur and enjoys short and long-term trading. With over a decade and a half of experience, Tony, along with his team at Robert Hall & Associates, actively look for the newest and most up-to-date strategies to implement on client tax filings. They operate with the same goal in mind, which is to help taxpayers keep more of their wealth and not overspend with the federal and state revenue agencies. Tony, welcome. Thanks for joining us, and I'm excited to hear what you have to say.
Thank you, Dmitry. Thank you, everyone, for having me today. Excited to come and speak with like-minded individuals in the real estate investment world. I know that taxes aren't exactly the most exciting topic to talk about on a rainy Wednesday afternoon, but I'll tell you, it sure is important to know and understand if you ever want to make money in the world of real estate, and more importantly, retain wealth, right? Tax, saving on the tax side of things. So, Dmitry, I just want to ask, can you see my screen? Yes.
Yes, it's up.
Okay, perfect. Yeah, it says sharing. I just can't, for some reason, I can't see it on my end. It does say it's sharing. So perfect. I've known Dmitry and Sense Financial for a very long time. So once again, Dmitry, thank you for having me back. Our two industries go hand in hand in more than just a couple ways, obviously. What Dmitry does on his side is just a really key part of the strategizing that we do on the tax side of things. A big part of what we do here at Robert Hall & Associates, myself included as an enrolled agent, senior advisor here at Robert Hall, is we do a lot of planning prior to year end. And one of the more consistent conversations with our clients during, October, November, and December is, hey, we see what your income has been this year. We see what your expenses are now. Let's try and figure out other creative ways or measures to help reduce this bottom line even further, or increase refunds if we're looking at refunds. And one key part of that planning is talking about deferred retirement. Some clients choose to go the Roth IRA contribution route, or the self-directed Roth, or the Roth 401k route, which then grows tax-free and doesn't really save them anything on the tax side right out the gate, but it does give them that tax-free growth in the long term. And then others are looking more for the tax sheltering benefit on the traditional side of retirement contributions. And that is a dollar for dollar reduction of taxable income. So it's really important. What I'm trying to get at here is it's really important for you to set aside some time prior to year end to sit down with your tax advisors and really map out a strategy and hopefully figure out what your tax return looks like even before the year is up, right? That's a very, very powerful position for our clients to be in. If literally in November, we have enough information to project what the tax return is going to look like, then when they actually come in during tax season to file their returns, they already know what the results are because we planned ahead, right? Failing to plan is ultimately planning to fail. I always remind people of that because I think it's a motto in life as a business owner, as a real estate investor. You got to plan ahead, right? And I think Dmitry and Sense Financial and Robert Hall & Associates, we do really well together business-wise because we follow that same motto from a planning perspective. So today's topic, 2025 top tax strategies for real estate investors. Once again, my name's Anthony Watson. I go by Tony Watson. I'm almost two decades now in the business of tax preparation. I am not only a senior enrolled agent here at Robert Hall & Associates and also a partner here at our firm, but I'm also the keynote speaker. And I speak at over 140 plus events on an annual basis. My individual column of clientele wealth ranges in between about $500 and $600 million in managed real estate, as well as other business dealings. So I individually see a lot in the tax world, but as a firm, we prepare roughly around 12,000 tax filings per year. I by no means am a one-man operation. I work alongside a wonderful senior consulting staff as well as a wonderful administration staff. We have about 56, 57 employees here at Robert Hull & Associates. We are power by numbers. We service 12,000 filings across the U.S. And so therefore we need, this wonderful staff that you see here in the picture. Robert Hull & Associates has been around since 1971, so we've been open for more than 50 years. This is a little out of date. It says about 10,000 tax returns, but it's actually around between 11.5 and 12,000 returns a year. Much like Sense Financial, we've got great reviews online, so you can check us out online, roberthulltaxes.com, learn a little bit more about what we do. The services that we offer under our one roof, this is what Bob Hull dreamt up back in 1971 when he started off literally working out of a garage preparing taxes in the early 70s. At that time, he was an educator with the Glendale or Los Angeles Unified School District. And over the last 50 plus years, he's built our operation to service 12,000 tax filings across the U.S. It's quite the inspirational story of how you can truly build wealth from nothing, to be real honest with you. And I was lucky enough to have Bob Hull Sr. as a mentor for many years when I first started here at Robert Hull. But we offer much more than just tax preparation services, incorporating services. If you're looking to set up an LLC, an S Corp, a C Corporation, we can assist with the setting up and structuring of those entities. We do internal auditing, bookkeeping services, payroll services, you name it. We've got most of our services under one roof. And then we have our wonderful vendor referrals, such as Sense Financial, that we usually involve in our holiday mixers and mingles, our real estate summit that we're going to have here in Glendale next January, finally back to having that big event in person. So we also have just a very sizable Rolodex of vetted vendor referrals that we can connect you with, much like how we do business with Sense Financial. We do offer free consultations as well. I do want to mention that now. I'll mention it at the end when we do a little bit of Q&A. So keep that in mind, that it's not just you have to pay for our services right out the gate. Let's do a little bit of a meet and greet, 30-minute in-person or over the phone consultation, just to see if we're a good fit for you. Every accountant is cut from a different cloth. So I'm not going to sit here and tell you that we're the people's accountants, right? We are here to assist as much as we can. We're here to advise on every level of business that we can advise on. But sometimes clients feel like, maybe we're too far from their location of business. Maybe we speak too fast. I don't know. So you've heard it all over a 20-year career. You've heard all of those insights to how people enjoy our services and choose not to work with us. But make that decision for yourself. And once again, we do offer free consultation. So once again, I'll remind you about that at the end. Today, what I'm going to talk about, just understand that even though I might be stepping out of my lane of expertise briefly, I'll try to reroute myself back onto the proper path. I am not an attorney, so please do not take any of the advice today or any of the conversations or topics in a legal fashion. I am not trying to give you or provide legal advice. This is something that my attorneys wanted me to include in all of our webinars for many years now. Everything today is solely from an income tax perspective, strategy perspective, and a professional as an enrolled agent in the income tax world. It's only income tax from a tax professional advice or direction. By no means am I trying to provide any legal or asset protection advice. Once again, I'll share a little bit about what I know, but you always want to take that information for a more detailed conversation with a legal advisor at a later date. So what are some changes coming up in 2025? Obviously, we have a new president in the House. We've got new legislation. We've got a ton of, executive orders that have been signed. But what about the tax bill? What has changed so far for 2025? What's 2024 going to look like? Are there retroactive changes for 2024? Well, unfortunately, I don't have an update for this year just yet. There is a rollout of a bill that is said to be coming out at the tail end of April. I assume that is going to happen. However, usually in years that a new president takes office, I'm not going to say that consistently it happens very quickly or within a year even, where the tax code is revamped to kind of follow the platform or guidance of the current sitting president. But I do know one thing for sure is that Trump wants to revamp basically everything that Biden put in place under the Inflation Reduction Act, which means bringing back 100% bonus depreciation benefits, which means revisiting child tax credits, means revisiting the SALT limitation, which is currently capped at $10,000, which actually was a Trump administration tax code change. But they are talking about increasing that SALT limitation to upwards of $50,000, $60,000. They will also be revisiting the mortgage interest deduction, which is currently limited to $750,000 of acquisition debt. I am very much looking forward to end of April and having some idea of where the tax code is going to be, is going to head direction wise, because let's face it, whether you live here in California or elsewhere in the US, we need relief. Specifically and especially in states like California and New York, where we have 2 teachers in the LA Unified School District or Orange County Unified School District, where 2 teachers are making $150,000 to $160,000 a year, W-2 income, and they are being limited to the amount of property tax deductions they can take on their individual return. It's a nightmare. It's an absolute nightmare. And I have no idea where that $10,000 cap came from. My assumption is that at the federal level, if you're looking across all 50 states, maybe that $10,000 threshold benefits or doesn't impact maybe 46, 47 other states. But outside of New York, or just not including New York, California, and Hawaii, we are the states that got hammered the worst, right? We're the ones that have the heaviest restrictions on deductions for Schedule A write-offs, which are our property taxes, our mortgage interest deductions, and our charitable write-offs. So I'm really looking forward to seeing what changes kind of are focused around the property tax limitations. The SALT deduction is what they call it. SALT stands for state and local tax deductions, as well as the mortgage interest write-off on the first position loans for primary use, as well as a second personal residence. When you turn around and rent out a property, there are no limits to what you can deduct in property tax and mortgage interest. So on the business side, that doesn't really apply. This is more for the individual primary residencies and personal second residencies. We are seeing and continue to see some significant limitations on those deductions. So as soon as we have that update on 2025's tax code, before we actually started the webinar, I mentioned this to Dimitri, at the tail end of April, maybe in May or June, we'll be back with a lot of the updates and what could potentially be retroactive for 23 and 2024. For those of you who went out and did a cost segregation analysis on your rental properties in 2024, or even in 2023, and you were limited to either 80 or 60% of bonus depreciation, if Trump decides to bring back 100% bonus depreciation, we might see a lot of amended 2024 and 2023 tax returns. Is it possible for him to make those changes retroactive to 23 and 2024? Is it possible? Yes. Is it likely that he's going to make it retroactive? Probably not likely. Is it possible though? Absolutely. We've seen it before. I've seen it in my 20-year career where things start or a new code is introduced and then they make the start date actually halfway through the prior year or even 15 days prior to the end of the year. Or at least give the taxpayer the option to go back and amend tax returns to add that benefit onto the return, not really requiring them to amend their returns, which I think is nothing but a good thing in this case. As you can imagine, going and doing a cost seg analysis in 2024, buying a heavyweight vehicle for business use and only being allowed 60% of that benefit. Well, I mean, if he makes this retroactive to 2024, you could go back and get 100% versus 60%. So I'm knocking on wood, praying to the tax gods every day that this actually does pass. And I do personally believe that Trump has already changed a lot in his very short time as president in the second round of his second term here as president. I think he's going to move quickly and swiftly, and it is very possible for him to make some of these changes retroactive to 23 and 24, just as a side note. As we enter into this tax season, it's February 12th. Tax season officially didn't actually start until January 27th. That's when the IRS opened up their e-file system. So we have actually had some successful e-files already. On the corporation, the LLC, S Corp, and C Corp side, there are still some forms that California is waiting to finalize. So we haven't actually successfully filed any entity returns this tax season. So we're waiting for California to update some of those forms. But there are still some forms out there that just need to be finalized. But we are approaching our filing dates, right? So we want to start gathering all of our expenses, gathering our income figures, and figuring out as many positions as possible to help us offset income, help us retain wealth, pay less tax, so we can free up some cash to invest in 2025, whether it be in real estate assets, maximizing deferred comp investments, paying off student loan debt, whatever you're trying to do with that freed up cash. Let's make sure that we maximize all of these positions as we get ready to file our 2024 tax returns. So what are some of the top tax deductions as we approach filing season this year? Number one, for a lot of businesses, continues post-pandemic to be marketing and advertising. I can't stress this enough that if you are a self-employed individual or if even you're a rental property owner and let's say you have a vacancy, how do you fill that vacancy? Well, you need to promote the listing, right? So every dollar you spend in marketing and advertising and promoting your business or your vacancy on your rental properties, that's going to be a dollar for dollar federal and state tax deduction. Dollar for dollar, meaning if you bring in $50,000 of income, you spend $5,000 on marketing and advertising, you don't pay tax on 50 grand. You pay tax on $45,000 because it's a dollar for dollar adjustment to taxable income. So another job of a licensed tax advisor is not only to file your tax returns and to do planning for you, but it's also to figure out as many dollar for dollar tax deductions for you as possible, or explain to you what is a dollar for dollar write-off and figure out how to maximize those deductions on the calendar year's return that you're filing for to help you retain wealth, right? What you might consider to be tax savings, I consider to be wealth retention. So we are trying to retain as much of that wealth that you've built for yourself over the past 365 days as possible. The money is better spent out of your account than it is out of the government's account. And after everything that Doge has found that the government has been spending money on, you clearly know what the government does with our money now, right? It's probably never been this transparent in the history of the United States of America, to be real honest with you. This transparency is crushing for a number of reasons because it truly shows you when we pay tax or when we overpay or pay more than our obligation in tax, I guess you could say, what the government turns around and uses that money for, right? So I think that we can all agree that it's much better spent out of our accounts than out of their accounts. And the way that we retain that wealth is just by doing proper tax planning and figuring out all of the creative ways to dollar for dollar reduce our taxable income and keep that money in our accounts. Number two, professional supplies and equipment. When you go out and you buy a new laptop, when you buy a new cell phone, when you buy a new tablet, when you buy a desk, a chair, a filing cabinet, a shelving unit, all of these are tangible assets, depreciable assets for your business. And the federal government will allow you a dollar for dollar adjustment for that brand new $1,800 laptop that you purchased, for the $1,200 iPhone that you just purchased for business use, for the $2,000 executive desk that you bought because if you were here in my office, I have a desk that, no joke, has probably been in the Robert Hull & Associates building for 35 years. It still looks nice, right? I've been meaning to get an updated desk and I get the deduction for that, obviously. But, if you're looking for updating office equipment and office furniture and all of the other things that allow you to be more effective at what you do, or maybe have a nicer work area, the federal government allows you to dollar for dollar adjust your taxable income by these expenses. So keep that in mind. I not only like this deduction for a number of reasons, like upgrading and reinvesting profit back in infrastructure, but also, just as a side note, this particular slide that you're looking at, these items have one of the lowest audit rates out of all deductions that you see on an individual return or a business return. I mean, think about it. How many people do you know who can do what they do professionally in today's world without a laptop, without a cell phone, without a camera? The cameras that we're using for today's webinar, right? These are the most consistent deductions for business owners. And so therefore they have the lowest audit risk. I have yet to see in my career an audit on an Apple laptop purchase. I have yet to see an audit on a cell phone purchase. Sure, in the entertainment industry, when you spend $50,000 on a camera lens, sure, those are a little bit higher of an audit trigger because of the size of the deduction. They want to make sure that that's a legitimate write-off and that you're not just giving it or making up a value for that item just to save tax. But on the tablets, the cell phones, the desks, the chairs, the filing cabinet, shelving unit, storage units, those are, once again, less than probably a 0.1, but 0.0001% chance for audit. I'm going to give you some really unique statistics at the end of my presentation today. But I'm going to tell you exactly what your audit percentage rate is based on what you make in income, which will blow your mind about, everybody fears being audited by the government. But once again, the audit rate is so low on certain returns that you got to make sure that you're maximizing these positions as much as possible while continuing to understand that, you don't want to step over the line, but you want to go right to the line deduction wise to make sure that you're retaining wealth and paying your, basically not a penny more than your obligation in tax on an annual basis. So professional supplies and equipment continues to be number 2 on the top 5 deductions. Number 3, I had mentioned just a couple minutes ago that the end of April will be the rollout of a new tax bill. I'm hoping that it happens sooner than that. Actually, I hope that it happens, but I'm hearing that it's going to be towards the end of April, which will change the bonus depreciation that you get on vehicle purchases. As of now in 2025, the bonus depreciation is set to be 40% of whatever that capital asset purchase value is. So you go out and you buy a Toyota Camry, or you go out and you buy a Range Rover, right? 2 different weight class vehicles. The Toyota Camry maxes out the depreciation deduction at about $22,500, which at the moment you only get 40% of. With a bonus depreciation vehicle weighing over 6,000 pounds, like a Range Rover or a Chevy Tahoe, or even a Chrysler minivan weighs over 6,000 pounds, you get on 100% of the purchase price, you get 40% of that as a bonus depreciation write-off. Like I had mentioned a couple minutes ago, Trump's administration is talking very seriously, and this is, probably 90 to 95% true that this is going to pass. They are trying to bring back the 100% bonus depreciation benefit, which means that if you go out and you buy a Chrysler minivan for business use, you go out and you buy a Chevy Tahoe, a Silverado, a G-Wagon, Mercedes G-Wagon, a Sprinter van, for real estate professionals who are giving tours of their properties in different areas or communities. These are all vehicles that weigh over 6,000 pounds. And when Trump does introduce this benefit back to the tax code, 100% of that vehicle could be a potential write-off for you. I mean, imagine that, making $100,000 in profit, paying $100,000 for a Mercedes Sprinter van that you're going to use for business use. And now all of a sudden you've wiped out your federal taxable income down to zero, all by reinvesting the profit back into a heavyweight asset. California doesn't allow for that benefit. So California is only going to allow for a portion of the depreciation as a write-off. But the IRS, if this code does change or revert back to what it was in 2021, that could be a huge benefit for taxpayers here in the U.S., especially self-employed individuals and real estate investors. We don't have eyes on this part of the tax code just yet. So more likely than not, you're either going to buy the vehicle and take 40% of the depreciation, or you're going to take the mileage write-off at about 65 cents per business mile, which is still a great overall tax write-off. You cannot take both. You cannot take mileage and the depreciation write-off. It's one or the other. Okay. I see that people think that sometimes it's the Wild West and, you want to take the mileage and the gas receipts and the actual auto cost, plus you want to take depreciation. Unfortunately, it's one or the other. So you got to talk with your tax preparer in more detail about how to navigate that part of the Internal Revenue Code. Number 4, legal and professional fees. The only reason why I throw this into the top 5 is because back in 2018, when Trump's administration changed the code under the Tax Reform Bill of 2018, they got rid of legal and professional fees, which included tax preparation fees for W-2 employees, right? But nothing changed for self-employed individuals or real estate investors. You are still allowed the dollar-for-dollar deduction of legal and professional fees, whether it be tax preparation fees, attorney fees to review lease agreements, anything that is considered to be a legal and professional fee. You have the unique opportunity to still deduct these expenses, whereas a full-blown W-2 employee is no longer allowed to write these things off. And that's as of 2018. That still continues to be a limitation that hits only W-2 employees, which the unfortunate part about this is the people who get hit the worst are the teachers, the firefighters, the police officers. State of California still allows them to write off their unreimbursed employee expenses, but the federal government actually got rid of what's called a 2106 unreimbursed business expense form back in 2018. I'm hoping that in this tax bill rollout in April, hopefully they bring that back. Because at the moment, the teachers who educate the youth of America, when they take the kids on a field trip, when they buy prizes and awards for the classroom, when they have to come out of pocket for pens and supplies and things like that, they aren't able to write that off on their federal tax returns. Very sad. And the districts are not reimbursing them for these expenses. So it's truly a teacher making, $40,000, $50,000, $60,000 in some cases, maybe if they're lucky in LA Unified to be a tenured employee making $110,000, $120,000 a year, spending $5,000, $6,000 on classroom supplies. That's a lot of money to a teacher. It's a lot of money to anybody, to be real honest with you, but to not be able to write that off, it's criminal in my mind. So I'm hoping that does come back. But at the moment, we have a unique opportunity to still deduct these expenses as self-employed individuals and real estate investors. Last but not least, property deductions. So for the self-employed individual, if you're writing off an in-home office deduction, great. I don't ever want a client to fear taking an in-home office deduction. I want to be very clear with that. It is incredibly important for you to understand that the sole reason why the in-home office form has a high audit risk is because people tend to not be reasonable with the square footage allocation that allows them the deduction, right? So if I sat here on today's webinar and told everybody that they should be allocating 25% of their home for in-home office space, well, I might live in a 1,000 square foot home. You might live in a 5,000 square foot home, and 25% of 5,000 square feet is much bigger than 25% of 1,000 square feet, right? So you got to make sure that you're being reasonable with the allocation. That is the one thing that gets the in-home office form pulled for audit, is the unreasonable allocation of square footage. So just be aware that it's not you just simply throwing the form on the return that gets audited. I mean, this is a completely ordinary, necessary, and legitimate write-off for all self-employed individuals. And so you should be taking this deduction. If you work with a tax advisor that says, hey, we shouldn't take this because it's going to increase your risk for audit, you need to work with a different preparer. Okay, that you should never fear taking a legitimate position on your return. You just got to make sure that you're working with a tax advisor that knows how to advise you on the reasonable nature or allocation of an in-home office space or deduction. So keep all of that in mind. Let's talk really quickly about the power of bonus depreciation, because this is really key for real estate investors. I don't know if all of you have heard of cost seg before. My assumption is yes, because usually Dimitri's audiences are not the intro to real estate investors. They're usually the veteran investors, and they've been investing for a pretty long time. But just as a quick refresh for those of you who are veteran investors, or even an intro for people who are just starting off in the real estate investment world, there's something in the tax code or built into the tax code called cost segregation. Some of you might have heard of cost segregation before. For those of you who do not know what cost seg is, it is one, in my opinion, it's one of the unicorn parts of the Internal Revenue Code. I have a 3.5-year-old daughter. Her room is filled with unicorns. It's all pink and beautiful. And I do know that unicorns are these mythical creatures that don't exist, obviously, but they're mythical and they're magical in so many ways. And so I refer to the cost seg election as a mythical creature, as a magical part of the tax code, because it does so much for the real estate investor to help offset liability. And in some cases, it fully offsets the complete liability of a taxpayer so that they can retain that wealth and buy more real estate and basically copy and paste year over year. They do the cost seg this year, they help themselves pay nothing in tax. They take that money, they buy more real estate, and in the following year, they elect cost seg again. Now, this could be on your own individual properties. It could also be on properties held in real estate syndications. So also, when you are investing in syndicated investments, you also want to work with syndications that are very tax savvy from a real estate investment perspective. They know how to utilize these parts of the code to help offset cash flow. So as that cash flow passes through to you, even though you might be making profit on the investment on the K1 or the pass-through documents, you show nothing in profit because of these very special elections that are allowed under IRC Section 481A, I believe it is, of the Internal Revenue Code, which is the cost segregation tax code. So here's how cost seg works. This is a true life example, by the way. A new client comes to me in 2022 to file 2021's tax return, right? He comes in and he says, hey, listen, I'm an LADWP worker. I'm employed as a W-2 wage earner, but I don't want to work for LADWP forever. I've got 3 properties under my wing. I want to eventually build my real estate wealth to a point where I don't have to work for LADWP anymore. I've got a great pension with them, but I want to be a real estate professional. I want to actively participate in the management and acquisition side of my real estate investment. And so I say, okay, well, that's possible. Let's dial in 2021's tax return. Let's see it. Let's figure out where you land right now, bottom line wise, and then we'll figure out if there's anything else that we can do. So we prepare this 2021 return. Taxpayer A has got a fantastic cash flow through his 3-property portfolio. He's got a pretty nice W-2 through LADWP sitting at about 120 grand. He's got $33,000 in cash flow. And without doing anything, without implementing any change or implementing any strategies on the cost seg side, he originally was owing about $4,000 to the IRS and about $4,200 to the state of California. So about $8,200 overall in federal and state income tax. And so we sit down and he's like, listen, Tony, I don't want to owe that money. Is there any way that we can help to offset this? I don't really want to put any more money into my properties. They're already kind of livable, and he's liking and enjoying the cash flow. He's setting money aside to buy more property. And so I say, well, you could be the perfect candidate for a cost seg election. And he looks at me cross-eyed and he's like, well, what's cost seg? Well, what is that? Is that a new variant of COVID? And I said, no, it's not a new variant of COVID. Cost seg is a special election under Internal Revenue Code, Section 481, that allows us to reach forward into future years and accelerate depreciation on the building alone, not the land. Land is not depreciable. It's not amortizable. It's just land, just sits there. And that's where all the value of real estate normally is in the land. But the building is depreciated over 27 and a half years. And so why wait that full 27 and a half year period if we can reach forward into that 27 and a half years and accelerate some of that depreciation, take it as a write-off now, save the money in 2021, put that aside, buy a new property in 2022, and then do cost seg again in 2022, and just copy and paste as the years go by. And that way we're not paying tax on the cash flow, we're retaining the wealth on the W-2 side, and that might accelerate his timeline for retiring from LADWP, moving full-blown into the real estate investment world. So that's exactly what we did. In 2022 for the 2021 year, because it didn't have to happen in 2021. This is when we're sitting in my office in 2022, we made a backdated election to do cost seg for 2021. And we were able to accelerate close to, I believe it was $400,000 in depreciation. I think you guys can see where my little highlighter is here. Look at what happened to that $33,000 in cash flow. It went from 33 grand in profit to an $11,549 loss. Now, he is limited on the amount of loss he can take because he is a W-2 wage earner in this scenario, not a real estate professional. And he is on his way to phasing out from being allowed any real estate related losses once his income breaches 150 grand adjusted gross income. So even though he's not able to take the full $400,000 481A adjustment, which is the amount of depreciation we were able to accelerate on the 3 property portfolio, he was still allowed in this year about what, $44,000, $45,000 of the loss. And the delta of $360,000 he doesn't lose, he just doesn't use it in 2021. So you don't lose it, you just don't use it. So it carries forward into 2022 as what's called an unallowed passive loss carry forward, and it offsets his cash flow in future years. Now, let's just for argument's sake say that taxpayer A decides that he doesn't want to own any more property, right? He's happy with this 3 property portfolio. It's cash flowing about 33 grand a year. And he just does this cost seg in 2021. How many years can he use that $400,000 or that $360,000 leftover loss carry forward before he runs out of it, right? Well, simple calculation, take 360 grand divided by $33,000 in cash flow on average per year. He can use that loss for the next 10.9 years, right? Almost 11 years. And for the next 11 years, he pays nothing in federal and state income tax on $33,000 of cash flow. So what difference did that make to his bottom line? Originally, he was owing about $8,200 between federal and state. Now, after this cost seg election, simply only taking about 44 grand, 45 grand of the loss. Now he's looking at close to a $6,000 federal refund on the bottom line. And on the state side, he kicked into having a $1,392 write-off. So what is that difference? $7,392 plus $8,200. That is a $15,500 delta, right? He went from owing $8,200 to now getting a refund of what, $7,300, $7,400. That saved him $15,000 in tax just in 2021. So let's say that he can use this loss for 10.9 years. Let's take $15,592 times 10 years. Over a 10-year period, by simply doing that cost seg election in 2021, over a 10-year period, it saves him $155,000 plus in federal and state income tax. All for doing a $1,200 cost seg study in 2021, right? That's not what taxpayer A did, though. Taxpayer A did the cost seg in 2021, saved all this money, had money set aside for a new acquisition. He bought a new property in 2022. We did cost seg in 2022, accelerated depreciation, saved all the money in 2022. Then he bought more property in 2023. Now he's sitting on about a 6 property portfolio, and he's got about $900,000 in carry forward unallowed passive losses on the real estate side. And guess what he did in 2025, January 1st of 2025? He retired from LADWP. Now he actively manages his property. He's got a great pension. He's not fully retired yet, so he's not collecting on his pension, but he's got incredible cash flow through his properties. He was able to maneuver around some money to hedge actually a low rate of 4 to 4.25% on his new acquisitions through an asset depletion loan. He wasn't affected by the fires, thank goodness. And so, like a lot of our clients were, but, he set himself up for his goal. In this was 2022 that we met to start this plan, and it's 2025. So in 3 years, he was able to meet and exceed those expectations. And now he is in retirement, now managing his own real estate portfolio. And we are checking that real estate professional box on his 2025 return next year when we file in 2026. So for those of you who think it's not possible, here is a real life example of how it is possible for a life to change in a matter of 3 years. You just got to plan ahead, put the plan in place, implement the strategies, and take the advice of your tax accountant. That's what you pay us to do. That's what you pay us to advise you on. If we send you out into the wild, which is what I call the real world, wild nowadays, if I send you back out into the wild and you don't implement our strategies that you've paid us for, there's nothing really I can do at that point, right? We can lead you to the promised land, but as far as you entering into the gates and seeing all of these benefits, that's up to you at that point. Okay. And there are costs to get all of this done. But at the end of the day, this goal was very much achievable for taxpayer A. Let's talk about 1031 exchanges really quick. For those of you who are active real estate investors, you're not seeing the kind of proper or expected cash flow through certain investments that you thought you would have by a certain period of time of investing in, a multi-unit building or a single family residence. Just understand that you're not locked into that property. You're not locked into that geographic location. The federal government, many, many years during my career, as well as over the last 100 years that Section 1031 has been around, the IRS has tried to change it. They've tried to get rid of it. They tried to alter this part of the code. And year over year at the 23rd hour, right as the tax bill is passed, nothing changes to Section 1031. So 1031 exchanges still in play, no limit to what you can defer as far as capital gain is concerned. It is also another holy grail kind of unicorn part of the Internal Revenue Code. This allows you to take your cash flowing investment or non-performing investment in some cases here in LA. Let's say that because of rent control issues, because of bad tenants, destruction to property, and years of having to improve the property, you're just not hitting those cash flow numbers that you want to see. The federal government allows you to sell that property into an escrow account, take all of that capital gain over the years of ownership, and reinvest that money back into other like-kind investments. Now, I've seen this done in a number of ways. Obviously, you can go from one property into one property of equal value, still carrying the same amount of debt. So if you have like a $500,000 loan on your current home, when you exchange into another property or multiple properties that you're exchanging into, you got to carry the same amount of debt on the newly acquired properties. Otherwise, you have something called boot in the mix, where the federal government says, even though you exchange the gain because you paid off debt in the exchange, you actually have to pay tax as if you accessed funds out of the exchange because you technically paid down the debt. So there's a unique calculation in the 1031 exchange world that we make for you just to make sure there is no debt or there is no boot that you would pay tax on. But you can go from one property into 10 properties. You can go from 2 properties into 4 properties. You can go from 10 properties into one Malibu beachfront property, probably not in Malibu right now, but a beachfront property that you want to rent out for $25,000 a weekend or whatever. I've seen it all in my career, especially here in LA County. I've seen it out of state use. I've seen in-state use. I've seen the Hollywood Hills mansions that are $25 million acquisitions. I've seen the Malibu beachfront properties, $50, $60 million acquisitions. I've seen property traded in more ways than probably anybody has ever seen in 20 years from a tax perspective. And so this is still very much in play. It allows you to defer the capital gain, not evade the capital gain, but avoid the capital gain tax. And what I like to call kicking the tax can down the road until you kick the can, right? So you want to 1031 exchange your properties throughout your lifetime and leave the overall income tax break and benefit for either your surviving spouse or your next of kin or an alma mater or a 501c3, whoever you're going to leave your assets to at the end of life. You want to kick that tax can down the road, because if you sell it outright during your lifetime, the federal government is going to tax you on the federal capital gain side. The state's going to tax you on the state capital gain side. And then all of the years that you were receiving depreciation deduction benefits as tax write-offs, in the year of sale, you have to recapture all of the years of depreciation and pay ordinary income tax on that figure as well, on top of the capital gain to federal and state. Right? So the 1031 exchange avoids all of that. It doesn't evade it. It avoids all of that until, once again, either you die and your beneficiaries or your surviving spouse receives a full stepped up basis up to $12.6 million per taxpayer right now, which means that literally within the week of your passing, your spouse or your children could sell those homes tax-free without capital gain tax, without recaptured depreciation tax. Within the week after you pass, because they get that full stepped up basis, they get to reset depreciation, they get to reset the value. I usually suggest for heirs and beneficiaries to keep the properties and rent them out, because now they get this massive depreciation write-off. Normally the properties are paid off and they can cash flow like crazy on that. So at the end of the day, I don't want to spend too much more time on this, but at the end of the day, it all comes back to proper tax planning, right? This might have lit a fuse under you or turned on a light bulb in your brain thinking, wow, I need this kind of tax planning. Utilize the free consultation with Robert Hall and Associates. Let's sit down. Let's map out a plan for you. Talk about the future and what your wants and needs are, right? When you want to retire, how do you get to that point? What can you do with moving your assets around, deferred retirement benefits, things like that? This is all part of the tax planning world, so keep all that in mind. These are the statistics that I really wanted to get to before we get into Q&A. I know we got a little bit of time left. Let's talk about the 4 red flags that are IRS triggers, okay? Number 1, when you have excessive credits or deductions compared to income, meaning that you have very low income, but you got all the credits in the world, the federal government's going to wonder how you were able to acquire certain assets that qualified for these credits when you have very low taxable income. Missing or underreporting income. How can you afford $50,000 in property taxes per year if you only make $30,000 in self-employed income per year, right? Sure, it could be savings that you have or inheritance, but at that point you'd have high interest earned and reported on the return. So the federal government looks at your investment accounts, your capital gain, your interest, your dividends. And if you've got 30, 40 grand in interest, they're going to know that you have a lot of cash in the bank account. And at that point, you can afford a $50,000 property tax bill per year, right? So it is a chess game. It tells a story to the IRS, and it's not an agent, like a live agent looking at this anymore. Guaranteed in the next 5 to 10 years, maybe even sooner than that, it's going to be AI software at the IRS level looking through these algorithms, checking balances of what you had in previous years. What was the growth of income? Is that kind of geographically speaking in your area, is that consistent with the norm? So that's the future of auditing is AI. I can almost guarantee, I put money on it, that that's the future of AI. Not there yet, but it is the future of auditing. Number 3, refundable credits. When you are at such a low income bracket where the government's paying you for being a single parent or a household with children, but your income's below $28,000, $30,000 of income, you actually at that point qualify for something called earned income tax credits. That's when the government, even though you haven't paid any federal or state taxes into the federal cookie jar, so to speak, which would technically trigger the refund, this is when you've paid nothing into the system and the government is paying you for being a low income earner. Okay. That is also something that triggers audits with the IRS. And then of course, using round numbers. I got an upload the other day for a client that has an appointment over the weekend, and they had filled out our questionnaire and all of the numbers were like $2,000, $500, $1,500, $1,800. And I'm thinking, you're just estimating at that point. If I put those estimated numbers, those round numbers on your tax return, that's just 1,800, 2,000, 5,000. The government's going to know that we're just estimating, that we're guessing. So I always need to do $18,002, $23,755. It's got to be an exact number, because at that point you're telling the government that you dialed that number into the T. I can't tell you how many new clients come in with self-prepared returns or returns even prepared by other tax professionals where they're just rounding numbers. Man, that is a huge red flag from an audit rate perspective. So keep that in mind. Here's a real eye-opener. Audit percentages coming out of the pandemic, post-pandemic audit percentages. Partnerships have less than a 0.1% chance of audit. Not 1%, but 0.1%. S corporations have less than a 0.1% chance for audit. C corporations, slightly higher. These are the Googles, the Amazons, the eBays, the SpaceXs of the world, companies that have over 100 shareholders, the billionaires of the world. They still have a pretty low audit rate, but it's much higher than the individual at 2.9% for a C corporation. Personal returns, get this, 0.38% chance for audit, not 38%, 0.38%. So this should be a little bit of an eye-opener for you. I'm not saying that, hey, because of such a low audit risk, hey, let's be super aggressive on your returns. But it does give you the ability to kind of step back and think, well, maybe I should keep closer track of my travel. And maybe when I was traveling to the East Coast, even though I was there for a graduation, I did hit up some realtors on the East Coast prior to traveling, and I got some flyers for properties that my California investors might want to invest in. Or I've been thinking about diversifying outside of the California market, and I traveled to Bozeman, Montana over the new year, which I did. It's a beautiful place. Make sure you rent cars with chains, though, because my wife and I and my 2 kids, we spent about 4.5 hours in a snowy ditch when we arrived because we rented a car that didn't have snow tires. So quite the experience. But if you're traveling in those parts of the United States and you want to buy rental investments out there, that could be a research and development cost for you. So think outside of the box, right? Have these conversations with your tax advisors, because you can't just look at the IRS code and think, okay, this is all deductible and that's it. There is very much something in the accounting world called interpretation of the tax code, how we interpret the code to read for real estate professionals, for real estate investors, for financial investors, for financial planners and professionals. We interpret the code to read a certain way so we can maximize those angles and help you once again retain wealth. That's what it all comes down to. Most audited returns, get this, you're gonna throw your head through a wall. Most audited returns are incomes under $25,000 and income above $500,000. Now, why do you think that is? If you're a middle income household between $25,000 and $500,000, you have the lowest audit risk out of all tax returns. Well, above 500 grand, yeah, we get that. In theory, the IRS is looking at these wealthy individuals. They have all these great tax shelters. And so at that point, they have money to pay for good tax advisors. They have money to pay for consulting, throughout the year, for special investments like conservation easements, fee simple investments, cost seg elections, things like that. But why under 25 grand? Well, remember what I said earlier about the credits, the refundable credits? When you make under 25 grand, you are a qualifier for the government paying you money. Meaning that even though you paid them nothing in tax throughout the year, the government's going to cut you a check for the earned income tax credit. And so the most audited returns land below 25 grand and above 500 grand, mostly because under 25 grand, the government doesn't want to cut you checks. They don't want to give you free healthcare. They don't want to give you a refundable amount from the Cover California subsidy that you get from Cover California, the marketplace health insurance. They don't want to cut checks to you for earned income tax credits, so on and so forth. So that's why they audit those individuals. For over 500 grand, they're just making sure that you're being reasonable with the deductions at such a high income bracket. Kind of an eye opener, right? Last but not least, will working with a tax advisor significantly reduce the risk of audit? I think that's kind of a silly question. I get that a lot on the seminar trail when I do webinars and whatnot. People have asked this before. Absolutely, it does. I mean, when we know how to make these special elections, especially cost seg elections, the 481A adjustments, you have to be very aware that it's not just simply putting the deduction on a Schedule E. We have to adjust your depreciation schedules to make up for what's being accelerated. We then carry that 481A adjustment over to the Schedule E. And then we also have to file, if it's a cost seg election done on a prior year purchase, we have to make a 3115 Form 3115 accounting method change, which is an 8-page document that we have to tell the government, hey, we've been depreciating the building as such over the past 2 to 3 years, but now we are changing the depreciation lifespan of the asset on anything that is below a 20-year improvement. So it's, once again, it's not just as simple as checking a box and allowing the deduction to flow through. There are digital PDF attachments, there's special elections that need to be filed, and there's also additional correspondence with other departments of the federal government. So yes, to answer your question, yes, it will absolutely reduce your audit risk by working with a tax advisor or a tax professional. Keep that in mind. All right. Once again, we do offer free consultations, 30 minutes in person over the phone. However you want to connect with us, we can do Zoom, Skype, FaceTime. I think we're in Zoho webinars today. So however you want to connect with our senior advisors, we are readily available to assist. Obviously, we're entering into the middle of tax season right now. Our schedules are starting to book up very quickly. Some of our senior advisors still have openings here and there. I would suggest that if we talked about anything that you have questions on today, shoot me an email, TonyWatson@RobertHallTaxes.com. We'll get you on the calendar, get the answer, see if we're a good fit. And if we need to onboard you for this tax season, we're readily available to do so. So, Dimitri, I'm good for Q&A.
Okay, Tony, great information. Thanks. You as always deliver. Folks, again, we're going to have a Q&A. We do have a couple of questions here, but this is your opportunity to ask specific questions. And I always say this, that, hey, it's not only you who are benefiting from the answer, but everybody else, because they might not think of a question, but you do, and you ask and you get the answer and everybody benefits. So don't be shy, ask those questions. But Joseph is asking, is that dollar for dollar deduction for marketing for all businesses or only real estate businesses?
All businesses. Great question. So today's group of individuals is mostly real estate investors. But if you have any self-employed revenue stream, from being a realtor who's earning commission income to e-commerce businesses, a lot of my clients nowadays have e-commerce businesses. Surprisingly enough, I've been doing a lot of the college paid athletes that are now getting paid for royalties from EA Sports and from online advertisements, jersey sales, things like that. And NIL, it's called NIL athletes. Online social media influencers, big growing business as well. All industries have the ability to market and advertise themselves. So it's a dollar for dollar deduction for all industries that require marketing and advertising costs.
Great. Alex is asking, I do own a rental property in my self-directed IRA. Can I use the depreciation deduction on my personal taxes?
Yeah, so it gets a little tricky when you own a property under your retirement account. If you have what's called a UBIT filing, which is unrelated business income tax, it's always a mouthful, UBIT filing, where you have debt financing on the property within your IRA. The portion that is debt financed can't actually be tax deferred in a lot of cases. I mean, there might be a couple situations where there's a workaround for it, but in most cases, let's say you have $1 million property, you've got a $300,000 loan attached to the property. That means that 30% of your property is financed, which means that 30% of the property's cash flow actually has to be reported on a Schedule E as not deferred income tax, because debt finance portions of property cannot be included as the tax deferral amount in your retirement account. And so the 30% of the property that is being taxed on a Schedule E, which, full transparency, it's not going to pay tax because we offset it with depreciation, mortgage interest, so on and so forth. We might be able to elect cost seg on just that 30%, or elect cost seg on the entire property, but only take 30% of it on that side. So there might be a workaround for that. We'd have to look at the numbers and see if it makes sense, though. Most properties won't cash flow simply because of regular 27.5-year depreciation expenses and mortgage interest and property taxes, insurance, so on and so forth. So we'd have to dive further into that, but that's a little bit of a more complicated question than just to give you a simple answer on here. We have to sit down with a consultation on that one.
Yeah. Well, Tony, let me try to maybe simplify it. Okay. So the question was, can you deduct depreciation on your personal taxes when your IRA owns a property? So the simple answer is no, you cannot, because this is not your property. Alex, just like if I, Dimitri, own a rental property, you cannot possibly deduct depreciation on a property that I own. That's nonsense, right? So I think it comes from the misunderstanding of that your IRA and you are two different entities, two different persons, right? So IRA is a separate legal entity. Your IRA is not you, and you are not your IRA. So what Tony mentioned is that applies to an IRA. Yeah, there might be UBIT tax on an IRA if you use leverage, but it's not possible to deduct depreciation on IRA on property on your personal taxes, if that makes sense. Am I correct, Tony?
Correct. So the only thing that depreciation can offset is the UBIT profit amount, but it's not going to help offset your income, like your W-2 income on your personal return. Yeah. It'll keep you from paying UBIT tax on the debt finance portion, but it's not going to help you offset ordinary income at all, unfortunately.
All right. Next, Pavel says, it's not a question, but he says, I would like you to do this for me. So I'm not sure what he was referring to. It came in as probably, Tony, you were talking about something. And yes, Pavel, Tony is the guy. You want to talk to him and he will do it for you, whatever that is. So get in touch with him and he will help. Next question from Tom. Do you assist with things like medical deductions?
Do I assist with medical deductions? I mean, I know how to write off medical expenses. So yeah, medical deductions are very unique. If you're self-employed, your self-employed health insurance premiums are deductible as an adjustment to income to the extent of profit that you have through your self-employed business. But as far as medical copays, doctor bills, prescription drugs, in-home help, like if you have somebody who's in the house taking care of a dependent or yourself, those medical costs would have to be over 7.5% of your adjusted gross income in order for even $1 to be a tax write-off. So it's one of the heaviest limitations set forth on the individual tax return side. So once again, the first 7.5% of your AGI and medical costs, not a tax write-off. But if the deduction exceeds that 7.5% number, then every dollar above and beyond that 7.5% limitation would be a medical tax write-off. I don't know how else I don't assist people with Medicare costs or anything like that. I know how to file the deduction on the return.
Perfect. Thanks, Tony. Laura is asking, is bookkeeping considered a professional deduction?
Very much so. But instead of putting it under legal and professional fees, I actually like to itemize that as bookkeeping.
Sense.
But it is a dollar for dollar write-off.
Yeah. Well, the hour is up. We probably be able to squeeze a couple more questions if you guys can put them up here in the Q&A. Otherwise, we are going to conclude. Going once, going twice. Any more questions for Tony? Well, Tony, again, been a packed hour with a lot of information, useful as always. Thank you for joining us. Folks, take advantage of the offer. Contact Robert Hall & Associates. Do your free consultation. I believe they'll review your tax returns for the last couple of years, right, Tony?
Correct. So we always suggest to give us 2 years of prior year filed returns so we can familiarize ourselves with your file before we hop on the phone for the consultation.
Yeah, you definitely should get a second opinion if even if you're using someone. I often talk. I'm not a tax expert, obviously, as Tony, but I do understand taxes, and sometimes I'm talking to people that are there because many of my clients are business owners. They own a business, and some of them make a lot of money, and they're still sole proprietors. And I'm like, your CPA, your tax preparer, never told you about incorporating. You can just, by doing this simple adjustment, you can save probably $30,000 on taxes. So it can be huge. So do get that second opinion. Talk to Tony and his team. But thank you for joining us, and we'll see you on the next webinar.
Good. Take care, everyone.